Hey everybody, it's Daniel here from InfoVest. Hope you're all doing well. So as you already know, last week the European Central Bank came out, did a surprise rate hike, but also in the statement mentioned that they are basically in restrictive territory. Basically signaling that, hey, I think we're basically going to pause and we're going to assess the situation. And that caused the euro initially to spike around, go up on the surprise rate hike, but right away it sold off and the euro was selling off as that statement basically gave the green light that, hey, we're going to pause unless, something drastic happens. Now, Lagarde did come out and did say in the press conference that they're still data dependent. So hold on, relax there. They can still raise rates, which was kind of confusing because in the statement you're like signaling a pause and then you come out and say that, hey, we could still hike rates if, inflation's not getting better. So is this a pause, not pause, or pause and kind of what Bank of Canada did, pause and wait and see? But I would say it's more dovish than what the Bank of Canada did, right? To me, it sounds like that they're pausing, but if something happens, let's say energy, for example, oil, we start to see $100 a barrel or higher, then obviously they would come back and retaliate and do something if the economy is still strong and nothing has broke yet. But with this pause, it makes you also think how the other central banks will start to react. And you're starting to slowly see that, especially with bond yields, German bond yields, and other treasury markets and their yields, where there is a kind of a sideways trading, a kind of consolidation there, more of a pricing that we're going to see from the markets pricing in. We're going to start to see rate cuts come in soon. And why is that, right? They could be signaling here that, something's going to happen in the economy. You're feeling the pinch of all the rate hikes that have already happened. You already tightened to levels that are back that we've seen in 2007. Rates are higher, yields are higher, mortgage rates are higher, and we're starting to see demand slow down, the growth slow down. We just have yet to see the employment component show major weakness. Although there are some signs, little bit here and there, but nothing so crazy just yet. And if the bond market's pricing in something that where we're going to see the unemployment rate skyrocket, or something in the lines like what China's facing, something breaking, some sort of black swan event, then sure, you can definitely expect the ECB, European Central Bank, being the first one to start to cut and react to that. And then you might see the other central banks follow, maybe the US Central Bank, maybe Bank of Canada, who knows, follow and start to cut rates as well. Now, a lot of people think that, hey, cutting rates is a good thing. That's going to spur up the economy and housing and equities. Although that is true, but initial reaction would be that, as we've seen in 2008, as the central bank there in the US were cutting rates, we had the quite opposite. Stocks were coming down, real estate prices were coming down, and it makes sense because if you think about it, rate cuts are a sign that something's happening in the economy. Some sort of credit event, some sort of event that's causing panic. That's when rate cuts would come in. Rate cuts would come in to try to save the economy. So, could we see the initial reaction of those rate cuts in the equity market? Sure, definitely we can. And this, before you get to the rate cut, you need to have the pause, which the European Central Bank started to do. And you probably see, again, depending on the data, that later on, if it continues to deteriorate or we see really major weakness, then the next step is rate cuts. And if the bond market is right and the traders out there are right that we're going to see rate cuts in maybe summer of next year or maybe earlier, then definitely you will see the bond market react and really rally accordingly. And then the equity market is going to be a different scenario depending on if we get that credit event or how bad this recession is going to be. But until then, we'll continue to watch the data. Until then, continue to also follow what the other central banks are saying too. They are globally coordinated. They do talk to each other. They don't just, do policies for themselves. Yes, they do have to watch their own countries and do adjust accordingly to what's happening within their own country, but they do talk. They do talk to each other and they do coordinate quite close to each other. Let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.